Hello and welcome back to this week's episode of Talking Freight, the weekly series where we talk about freight management and we give you practical tips to make managing freight just a little bit easier. It's brought to you by Ceresys, a transportation management company who provides solutions to shippers with technology and services. So, welcome to this week's episode where we're going to discuss a little bit about money. Now, we've talked about LTL freight rates. We've talked about some other soft options that you need to consider beyond that rate that you see at time of shipping. And today we're going to talk about some of those accounting options that you can configure when it comes to LTL shipping. Now, this is part of our larger LTL series that we've been doing over the last few weeks. So make sure you check out those episodes and don't miss a single episode of Talking Freight by going through our YouTube channel, hitting subscribe, and checking out a few of the episodes that we've done already. So let's get into some different accounting options when it comes to less than truckload shipping. The first one, the most common, is called prepaid. Now, this is when a shipper simply understands the rate they're going to pay, and they pay it. And all the shipping charges are paid by the shipper. Now, on an inbound situation, this is used when a shipper gets freight from multiple manufacturers or distribution centers. When you're going to receive freight from several amount of people, you want to make sure that you get the folks who are shipping to you the customer, paid up before it gets to you. It just saves you more time and money. You don't have a lot of freight charges out there, and you can make sure that you get reimbursed for any costs. You also want to be able to congregate return merchandise from multiple locations into one area. So this just makes it a little bit easier. For example, a retailer may be getting a lot of returns from customers, and it's a little bit easier to coordinate and get prepaid shipments from the accounting side if it's just going to one centralized return center as opposed to the maybe original distribution center where it came out to the customer. So it's used quite a bit in that reverse logistics type environment. On the outbound side, this is pretty straightforward. The shipping is simply paid by either you, the shipper, or the shipper shipping to you. And that's what is happening when people are shipping to you. They're on the outbound side, and so they've already prepaid that. And that's usually agreed upon before the shipping occurs between the two parties, either through a contract or on a one-time basis. The next one that you might have heard is called Prepaid AddIn or AddIn. Just like it says, it's going to be the cost of shipping plus an extra amount. Now, this happens a lot on the inbound side. For example, we have a customer who has many vendors, thousands of vendors who ship to them. Now, those thousands of vendors have some advantages when shipping to our customer because our customer takes care of all of the research of carriers. Our customer provides through our vendor management, transportation management portal that connects to our customer's master platform on their TMS. And all of that work is already done for the vendor. It's super easy to ship to our customer, really helps with vendor relationships. So our customer, because they've kind of already done all that work and made it easier and ultimately probably cheaper for that vendor than everybody arranging it on their own, they've added a little bit onto that amount. Now that's already been agreed upon within a contract, but it allows the customer who has a lot more volume and is working with thousands of vendors a little more control, and it's kind of like a nice discount on their overall freight because they've done all the work and made it easier for their vendors. So they've added that extra charge. On the outbound side, for those vendors, they're already going to know what they're being charged. They may not break out the different prices, maybe on an invoice, they'll just see one price. But you want to make sure that you don't trick anybody, that you don't just add this on and surprise them afterwards, that they already know these prices before they're going to ship out. So pretty simple in today's Talking Freight episode. These are just some accounting options that maybe you didn't understand or how it worked. Maybe you can reward your own hard work if you have a lot of vendors shipping to you because you've done all the work, or maybe turn to a third-party logistics company like Ceresys who can help you establish that so you can get a little bit of a discount on your overall cost. Often, like the customer I referenced, when you're able to add some to that inbound side and get a discount on those rates, what happens is you're almost subsidizing your outbound costs. So those are going to exist, but you kind of transfer those savings on the inbound side to lower your outbound cost, and your overall transportation cost in the end will be lower. So thanks for tuning in to this week's episode of Talking Freight. We'll continue our series with just a few more videos on less than truckload shipping in the next few weeks. Make sure you don't miss a single episode every Friday of Talking Freight. Hit that subscribe button on this video. Make sure you hit the bell so you're notified via email so you don't miss a single one. And check out the description below for some longer form blog posts when it comes to LTL shipping. Have a great weekend, and we'll see you next week.